All right, guys, what is up? And today I want to go ahead and get into a fair value gap strategy. Well, mainly sharing tips I use as a fair value gap trader. It's one of the only two setups that I trade. I trade fair value gaps and I also trade order blocks. I don't trade anything else other than those two types of setups. And yeah, let me just get right into it. If you're a beginner, experienced, this video just will be just for anyone who pretty much utilizes them or is looking to utilize them. So let's get right into it. So let me just minimalize this. Sorry, my eyes fucking been up all night trying to figure this shit out. This fucking hold on, guys. It's like lagging and shit. I'm gonna try to fix it. Feel free to fast forward the video. All right. So okay. All right. So what is a FVG gap? Fair value gap. So a fair value gap is an imbalance in price caused by institutions, specifically hedge funds, banks. Same thing applies to futures. They're the ones that have enough capital to have enough cluster of orders in the actual market to create um, inefficiencies in price action. So, like I said, like it says here, it appears as a large candle with little to no wick, leaving an efficiency between the previous and next candles. And if you look here in USD CAD, we have an example of one um, right over where I'm about to draw this arrow. If the arrow would fucking... Where the fuck is my thing at? Here it is. So, this is a gap right here, okay? Inefficiency, correct? And between the previous and next candles, leaving an inefficiency between the previous and next candles, and these gaps indicate where areas of price may retrace before continuing its trend, which it did. The gap is right there. Price came up. Sorry about the lag, guys. Price came up and retraced at that gray box. And if you were on it earlier, I didn't trade this, you would have. And the cool benefit about trading fair value gaps is that you can actually have tighter stop losses because of how institutions trade. They don't have a lot of drawdown, right? There's not a lot of drawdown because they like to tap and go. They like to tap into their zone, your fair value gap, order block. They tap in and they go. There's no hanging out in the stop loss area, which is why I like trading institutional concepts and which is why I like trading fair value gaps in the first place. So, yeah, you can have tight stop losses because most of the time you will get rejection candles tapping into fair value gaps. And another confluence is if you look at the bottom of the screen, we had which can be your proof that institutions caused the fair value gap. Look at the volume of the fair value gap itself. We're on the 4-hour time frame, and this is still counts as this is significant volume for the bearish because this is a gray candle, right? This is the candle of the gap right here. Well, this is the candle of the gap, and this is technically. And if you look at these two volume bars, it's actually increasing in volume, in bearish volume, because the gray I have on my chart for bearish volume. And the fact that it's even up and significant at all means that it's institutions. Because retail traders, especially in the 4-hour time frame, can't make enough orders. They don't have enough capital to have enough significance in volume on the volume chart. They're not going to be shown on the volume chart like this. They will be shown, but it'll be low volume because the ones that have high volume are the ones that have the most capital, right? So this was an institutional move and push down to the downside, and in result, leaving behind a fair value gap. So, yeah. So the benefits, like we were saying, precision entries, minimal drawdown, fair value gaps provide clear zones where price is likely to react and react pristinely, especially with wicks. You're going to see a lot of rejection candles on your entries if you trade fair value gaps. And also, this can be viewed as institutional footprint because when you're looking at fair value gaps, the fact that we just explained earlier with the volume, the fact that there's enough significant volume powering that movement in the first place is basically a footprint. And the gap itself is a footprint. Unhealthy price action in itself is a footprint because unhealthy price action is created by volume. and volume in order to have and volume in order for it to move the market, there needs to be some sort of event in the real world, especially if you're trading forex or trading futures. Doesn't matter. I trade both futures and forex. And so if you're watching this and you probably clicked off because you thought I was talking about forex whole video, but those of you that paid attention and waited a little bit, yeah. So let me get right back into it. So these can be viewed as institutional footprints whenever you see these gaps, especially in higher time frames, and you see the volume chart. If you use the volume chart at all, let's see, high probability setups. Yes, trading fair value gaps improves trade accuracy by focusing on the areas where price seeks to rebalance before continuing its trend, and it improves the accuracy, just like I explained earlier. Institutions don't have a lot of drawdown; they just tap and go into zones, especially fair value gaps. That's why I like trading fair value gaps, because my price isn't going to just hang out in my entry. Instead, it's going to tap into my entry and have an immediate push down. That's why you'll see online, everybody has those like clean sniper trades. It's basically like sniper trading in a way. So yeah, risk to reward optimization is an actual good point to trading fair value gaps, because when you're trading fair value gaps, it allows you to have a tighter stop loss and a better risk management, so you can take more trades because your risk is so low. And if you're actually counting your risk by lot and all that, whether you trade futures or contract, you can actually understand what your the exact amount of money that you're actually risking. And so it works across all time frames. I'm on the 4-hour time frame. I don't take entries off the 4-hour time frame. If I was trading this, I would go on a lower time frame and actually wait for it to tap in, and just like it did there. Look, here's what I would do. That was on the 4-hour, right? I would wait for it to tap into the 4-hour fair value gap, and then after, I want to see some sort of reaction. So after right now, it tapped into the 4-hour fair value gap, and after we saw all this unhealthy price action, right, leaving behind another fair value gap, and which was right here. And if you notice, is that a coincidence that the fair value gap I just drew had another wick tapping into it? Because that's how institutions work. They tap and go. This was the institutions tapping back in to fill inefficient price action. And then after we had inefficient price action filled, what did price do? Price came and price sorry. The result of price was bearish. We came down and we had a downfall after tapping into that gap. And so that's a way to enter, and that's a major tip I have, and I actually utilize that on a monthly to weekly basis, is if you're trading fair value gaps, and you identify fair value gaps in the higher time frame, wait for a reaction on the smaller time frame. If, let's say, you see a bullish fair value gap, right, that you want to buy on the 4-hour, and then you want to just enter it on the 4-hour, that's bad, because the 4-hour fair value gap, it can seem like it's a tight stop loss, but then you check your stop loss and it's like 50 pips. So what you're going to want to do is go on a smaller time frame, like the 15-minute, the 5-minute, and then wait for a break of structure or change of character, if you're familiar with that term, which is basically a disruption of the trend. And when you have that disruption of the trend, you can spot another fair value gap like I just did here on the screen, and then you can basically enter it. So yeah, guys, that's all I wanted to explain. And I trade, like I said, the only two trade sets I trade are fair value gaps and order blocks. Fair value gaps are much more consistent because they're literally everywhere. And another hack is, if you're a futures trader, it doesn't matter if you're a forex or futures trader, always check the money calendar. Like I say in every video, the money calendar is basically the economic calendar. I call it the money calendar, and it's Forex Factory. That's the only website I use, and I use it to basically find all of my setups. I don't trade unless I go on that website first. So if I'm on Forex Factory, I want to see all of my setups basically aligned with what's happening in the market. So if the US dollar is moving, I have potential to trade both Forex and futures. So if I want to trade gold, S&P 500 USD, US 30, NAS 100 US, like I can look at the US dollar, because that actually affects those futures. And let's say there's US dollar news at 8:30, especially not just any news, medium to high volume news, I can expect movement. And when there's movement, there's likely to be, because of the fact that it's high volume news, there is a more likelihood of that news affecting the market with inefficient price action. So normally, when there's no news in the market and there's no volume in the market moves a little bit up, maybe even sideways, right? And then when there's volume in the market starts expanding, and then when it expands, it leaves those in fair value gaps, and then you can get in on those retracements, and then that's basically my whole strategy. So yeah, guys, I hope this video was helpful. If you guys want me to explain this to you more, I have a free Discord. You can just join. If you're watching this on Reels, free Discord on my profile, whatever you're watching this on. I also I have a book that I made, a little PDF I made, has visual examples of my trading setup and also my actual strategy step by step, like the confirmations of it. Because like if you're trading, if you're especially if you're a beginner, you always, or if you're experienced, do this as well. You want to write out your strategy step by step, because if you don't and you're not memorizing it, then you're going to mess up and be emotional. So that way you can say, oh man, I really want to take this extra trade, but my strategy, it says only take 1 to 2 trades, but I want to take this extra trade. But you have your strategy written out on your desk step by step on your paper, and that's preventing you from over leveraging and making mistakes. So that's why writing your strategy step by step and writing the rules to it somewhere you can see is important. But yeah, I'm gonna end the video here. Peace.